Welcome to Trading Psychology, the 10 Secrets of Warren Buffett. Presented to you by Morrofx. In this audiobook, we are going to dive deep into the psychology, the mindset, and the inner habits that turned Warren Buffett into one of the greatest investors in history. People often focus on his strategies, his portfolio, his investments in Coca-Cola, American Express, Apple, or Geico. But if you look closer, you will realize that the real foundation of his success is not simply financial analysis, it is psychology. It is discipline. It is patience. It is a mindset that very few can master. Warren Buffett was not born a billionaire. He grew up in Omaha, Nebraska, the son of a stockbroker and politician. As a boy, he delivered newspapers, sold chewing gum, and even operated a pinball machine business. He was fascinated by numbers, fascinated by money, fascinated by how the world worked. But what truly set him apart was not just his love for business, it was his way of thinking. Even as a teenager, Buffett understood concepts that most traders and investors never master: the power of patience, the importance of discipline, and the psychology of staying calm when everyone else panics. This audiobook is not about copying Buffett's exact trades. It's about understanding the mindset behind them. It's about uncovering the 10 psychological secrets that allowed him to transform small sums into billions, and to sustain that wealth for more than 70 years. If you want to become a better trader, a better investor, or simply a better decision maker, these secrets will guide you. Let's begin with the first and most famous secret: patience. Most traders and investors fail because they cannot wait. They crave action. They want to be in the market every day, every hour, constantly chasing opportunities. But Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." And he has lived by those words his entire life. Buffett is not interested in trading daily noise. He is not interested in chasing short-term price moves. He waits for the right pitch, the right opportunity, the right alignment of price and value. And when it comes, he acts decisively. But until then, he is content to do nothing. Imagine the psychological strength this requires. To sit on billions in cash while the world screams about opportunities. To be ridiculed in the media for not buying when others are euphoric. To watch others get rich in speculative bubbles, and yet remain calm, knowing that their time will come. That is patience. Patience is not passive. It is an active decision to wait until the odds are overwhelmingly in your favor. It is the courage to do nothing when there is nothing to do. For Buffett, patience has meant sitting out of entire sectors, entire bubbles, entire manias. He avoided the dot-com craze, when everyone said he was too old, too conservative, too slow. He avoided the crypto mania, sticking to what he understood. People laughed at him in the short term, but in the long term, his patience always proved correct. How do you apply this as a trader? You must shift your mindset from action to precision. Every day, ask yourself, is this trade truly my setup? Or am I just bored? If the answer is boredom, you must not trade. Buffett would rather wait years for the right opportunity than waste his time on mediocre ones. And so should you. Patience is also about holding. Many traders exit winners too early, afraid to lose what they already gained. But Buffett holds positions for decades. Coca-Cola has been in his portfolio for over 30 years. Why? Because when you find true value, the real profits come with time. Selling too soon is another form of impatience. Letting your winners grow requires trust, discipline, and faith in your process. The first psychological secret of Warren Buffett is simple, but not easy: patience. The willingness to wait, the ability to endure, and the discipline to hold when value is clear. Now, let's move to the second secret: discipline. If patience is the ability to wait, discipline is the ability to act correctly when the time comes. Many traders believe discipline is just about following rules. But for Buffett, discipline runs deeper. It is about clarity of principles, and the courage to live by them, no matter what others say. Buffett has built his entire life around a simple, disciplined framework, by businesses he understands, at prices that make sense, with management he trusts. That's it. He does not chase trends. He does not bend his rules because of hype. He sticks to his framework, year after year, decade after decade. Think about the psychological strength that requires. In a world that constantly tempts you with shortcuts, with new strategies, with the next big thing, Buffett says no. Over and over again, he says no. He has repeated that discipline for 70 years. That is why his fortune has lasted, while others rise and fall with every bubble. For you as a trader, discipline means creating a plan and sticking to it. It means setting risk before you enter. It means never moving your stop when the market goes against you. It means protecting your capital at all costs. Without discipline, patience is useless. And without discipline, even the best strategy will fail. We will dive deeper into Buffett's discipline shortly, but remember this: he became the world's greatest investor not because he was smarter than everyone else, but because he was more patient, more disciplined, and more psychologically resilient. Discipline also means saying no. And Buffett has said no far more times than he has said yes. He reads hundreds of opportunities every year, yet invests in only a few. His discipline is the filter that separates distraction from true value. Traders could learn so much from this mindset. How many times do you enter a trade just because you're bored? How often do you break your rules because of fear of missing out? Buffett shows us that success comes not from the trades you take, but from the trades you refuse to take. And here is where psychology becomes critical. Discipline is not natural. As humans, we crave excitement. We crave novelty. We want to be part of the crowd. Discipline requires going against our instincts. It requires building habits that protect us from our own weaknesses. For Buffett, this habit is reading, thinking, and waiting, every single day. For you as a trader, this habit may be journaling, setting clear risk parameters, and reviewing your plan before every session. Without discipline, even patience becomes dangerous. You can wait for years, but if you act without discipline when the moment comes, all your patience is wasted. The two go hand in hand. Now let us move to the third psychological secret of Warren Buffett: emotional detachment from money. This may surprise you, because after all, Warren Buffett is one of the richest men in the world. How could someone with such wealth be detached from money? But listen closely to his words and his actions, and you will see the truth. Buffett does not treat money as an emotional object. For him, money is simply a tool. A way to keep score. A resource to allocate efficiently. When Buffett was a young man, he often spoke about becoming rich, but not because he wanted to buy yachts, cars, or luxury. In fact, to this day, he still lives in the same house in Omaha that he bought in 1958 for $31,500. He drives modest cars. He eats at McDonald's. He drinks Coca-Cola every day. His life is not built on emotional consumption. This detachment is one of his greatest psychological strengths. For most people, money is emotional. A big win makes them euphoric. A loss makes them desperate. They attach their self-worth to their account balance. This emotional roller coaster leads to impulsive decisions. But Buffett views money differently. He sees it as capital to be allocated, nothing more. This is why he can make massive investments without hesitation. In 2008, during the financial crisis, while others were panicking, Buffett invested billions in Goldman Sachs and General Electric. Why? Because his emotions were not tied to fear. He saw money as a resource. Where others saw loss, he saw opportunity. His detachment allowed him to act with clarity while the world drowned in panic. For you as a trader, this is one of the hardest lessons to learn. How many times have you taken profits too early because you were afraid of losing them? How many times have you doubled down on a loser because you couldn't emotionally accept the loss? This is attachment. This is emotional baggage tied to money. To follow Buffett's path, you must train yourself to detach. See money not as your identity, not as your self-worth, but as a tool for the game you are playing. Set your risk before you trade, and once the trade is placed, accept the outcome. Do not stare at the profit and loss line with your heart pounding. Focus on the process, not the number. Buffett himself once said, "Games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard." Money is the scoreboard. Process is the playing field. If you want to win, detach yourself from the score and focus on the game. This detachment also protects you from greed. When you no longer worship money emotionally, you stop chasing it recklessly. You no longer gamble to feel alive. Instead, you trade rationally, with perspective, with clarity. This is what separates Buffett from speculators who rise and fall with every bubble. He doesn't chase excitement, he chases value. So far, we have explored patience, discipline, and the beginning of emotional detachment from money. These 3 secrets alone can transform your trading if you take them seriously. But there are 7 more, and each will take us deeper into the mindset of Warren Buffett and the psychology of sustainable success. Emotional detachment from money is not just about ignoring luxury or living modestly. It is about building a shield against the psychological traps that ruin most traders and investors. Imagine the chaos of markets in free fall, screens flashing red, news anchors screaming, panic spreading across the globe. In those moments, most people see their money evaporating and they freeze. They make emotional decisions, they sell at the bottom, or they chase risky bets to make it back. Warren Buffett, however, thrives in those conditions precisely because his relationship with money is rational, not emotional. One of his most famous quotes is, "Be fearful when others are greedy, and greedy when others are fearful." At first glance, it sounds like a clever line. But in reality, it reveals a profound psychological principle. Greed and fear are emotional extremes that drive markets into bubbles and crashes. Buffett positions himself on the opposite side by detaching from those emotions. When others are euphoric, he becomes cautious. When others are terrified, he becomes bold. Without detachment, this is impossible, because you cannot act against the crowd if you feel what the crowd feels. This mindset was visible during the financial crisis of 2008. Banks were collapsing, institutions were desperate, investors were fleeing. Buffett stepped in with billions in capital, structuring deals with Goldman Sachs and Bank of America that not only rescued them but also generated massive returns for Berkshire Hathaway. The average investor was paralyzed with fear, but Buffett's detachment allowed him to see opportunity instead of doom. What traders must take from this is simple but challenging: you cannot win if your emotions dictate your trades. Every time you let fear close a position early, or greed tempt you into risking too much, you move further from consistency. Detachment means accepting losses without despair and accepting gains without euphoria. It means treating every trade as one of thousands, not as a life or death event. This is why journaling is so powerful. When you write down the reasons for your trade, your risk, and your plan before entering, you strip away emotion. The market may go against you, but your process remains clear. Buffett doesn't decide based on how he feels, he decides based on principles and evidence. That is the model you must follow. Detachment also creates freedom. If you are emotionally tied to every dollar, you become a slave to the market. But if you see money as a tool, you gain the freedom to think clearly, to wait, to act rationally. And that brings us to the 4th secret of Warren Buffett's trading psychology: independent thinking. Independent thinking is one of Buffett's most defining traits. He has never cared about following the crowd, the media, or even Wall Street analysts. From the very beginning, he was willing to stand apart, to trust his own judgment, even when it made him look foolish in the short term. Consider his early investment in American Express in the 1960s. At the time, the company was facing a massive scandal known as the salad oil swindle. Investors were dumping the stock, terrified it would collapse. But Buffett studied the situation carefully and realized that despite the scandal, the core business of American Express was still strong and trusted by consumers. While others fled, Buffett invested heavily. The stock recovered, and the decision became one of his legendary early wins. This pattern repeated throughout his career. During the dot-com bubble of the late 1990s, Buffett refused to invest in internet companies, even as critics mocked him for being out of touch. The media said he was finished, too old-fashioned to survive in the new economy. But Buffett stuck to his principles. He admitted he didn't understand most tech businesses, so he stayed out. When the bubble burst, wiping out trillions in value, Buffett's independent thinking was vindicated. Independent thinking requires enormous psychological strength, because it often means being wrong in the short term. The crowd will make you feel stupid, isolated, and outdated. But independent thinkers understand that truth is not determined by popularity. The market is not a democracy. Long-term success belongs to those who can withstand short-term criticism. This is where Buffett's confidence in his process becomes critical. He does not need validation from others. He does not care if the crowd disagrees. His decisions are rooted in his principles, his research, and his patience. That independence has made him billions, while others followed trends straight into disaster. For traders, independent thinking means resisting the temptation to copy every influencer, every Twitter signal, every news headline. It means building your own edge, testing it, and having the courage to stick with it even when others doubt you. If your process is sound, you must trust it. If it's flawed, you must adjust it. But never should you blindly follow the crowd. Independent thinking also protects you from herd psychology. Markets are driven by waves of emotion, pushing crowds into manias and crashes. To survive and thrive, you must stand apart. Buffett once said, "You can't buy what is popular and do well." Popular trades are often crowded trades, inflated with hype and ready to collapse. The independent thinker sees beyond the noise, waiting for opportunities where value is hidden, not advertised. There is a deeper lesson here. Independent thinking is not just about disagreeing with others. It is about clarity of vision. Buffett doesn't oppose the crowd for the sake of opposition. He simply doesn't let the crowd define his decisions. Sometimes he agrees with the consensus, sometimes he doesn't. The key is that his choices are independent, grounded in his own analysis and principles. As a trader, you must learn to filter. The market will bombard you with opinions, analysts, articles, social media, friends. Everyone has a view. Most are noise. Independent thinking is the ability to filter out that noise and focus on what truly matters. And that requires confidence, discipline, and above all, emotional detachment from needing external approval. The combination of detachment and independence is powerful. Detachment frees you from fear and greed, while independence frees you from the crowd. Together, they give you clarity, resilience, and strength. These are the psychological foundations that have allowed Buffett to thrive for more than 7 decades in markets that destroy most participants within a few years. Focus and consistency are among the most underestimated traits in trading and investing. In a world filled with constant distraction, new opportunities, breaking news, and endless noise, the ability to focus on one path and remain consistent is almost a superpower. Warren Buffett has mastered this ability like few others in history. From the very beginning, Buffett understood that he did not need to invest in everything. He only needed to invest in what he truly understood. His concept of the circle of competence is built entirely on focus. He studies businesses carefully, and if they fall outside his circle, he simply ignores them. Technology companies confused him for decades, so he left them alone. He did not feel pressure to chase what he did not understand. That laser focus allowed him to avoid mistakes that destroyed countless other investors. Buffett has also shown consistency in his approach over 70 years. While Wall Street constantly reinvents itself with new products, new strategies, and new fashions, Buffett has stuck to the same timeless principles: value, patience, discipline, independence. He does not chase fads. He does not rebrand his philosophy every decade. His consistency is almost boring, but boring is powerful when it compounds over decades. Traders often sabotage themselves by switching strategies constantly. One month they follow one system, the next month they abandon it for another. This constant chasing of the perfect system prevents them from ever building mastery. Buffett shows us that consistency, not constant reinvention, is the real path to greatness. When you find a system that works for you, refine it, adapt it, but stay committed long enough to let it compound. Focus also applies to concentration of capital. Buffett is not afraid to place large bets when he sees true value. While others diversify endlessly, spreading themselves thin, Buffett often concentrates in a handful of businesses he deeply understands. This requires enormous focus and conviction. For traders, the lesson is not to gamble recklessly, but to understand that true opportunities are rare, and when they appear, they deserve your full attention. Consistency also builds trust, not only with yourself but with others. Investors trust Buffett because they know he will not suddenly abandon his philosophy. Markets respect those who stay true to their process, even in storms. For your own trading, consistency builds confidence. Every time you follow your rules, your identity as a disciplined trader grows stronger. Every time you break them, it weakens. Focus and consistency are psychological anchors in a chaotic world. But how does one maintain focus and consistency over decades? The answer lies in the sixth secret of Warren Buffett's psychology: lifelong learning. Buffett is famously a learning machine. He spends the majority of his day reading books, newspapers, financial reports. He once said, "I just sit in my office and read all day." When asked how to get smarter, he held up a pile of reports and said, "Read 500 pages like this every day." That's how knowledge builds up, like compound interest. This commitment to learning is not casual, it is obsessive. Even in his 90s, Buffett continues to read for hours daily. His business partner, Charlie Munger, shares the same philosophy, once saying, "Go to bed smarter than when you woke up." That simple rule has guided them for decades. Why is lifelong learning so important for trading psychology? Because markets evolve. Industries change. New opportunities appear. The strategies that worked yesterday may not work tomorrow. Without constant learning, even the most disciplined investor will eventually become obsolete. Buffett avoids this trap by staying curious. He does not assume he knows everything. He does not cling to pride or ego. He remains humble enough to admit there is always more to learn. This humility keeps him sharp, adaptive, and relevant across generations. For traders, lifelong learning means constantly studying, not just markets, but psychology, risk management, economics, history, and even yourself. It means reviewing your trades, finding patterns in your behavior, and improving your weaknesses. It means reading widely, questioning assumptions, and staying open to new ideas without being seduced by every fad. Learning also compounds like investments. A single book may not change your life, but thousands of books over decades transform you into someone unrecognizable from where you began. Each piece of knowledge adds a layer of insight, and over time, you develop mental models that guide your decisions with increasing clarity. This is how Buffett thinks, not in isolated facts, but in a network of mental models built over a lifetime of learning. There is also a psychological benefit to lifelong learning: it reduces fear. The more you understand, the less uncertainty paralyzes you. Knowledge does not eliminate risk, but it gives you the confidence to face it. A trader who understands market cycles, human behavior, and probability will not panic as easily as one who trades blindly. Buffett embodies this principle. His calmness in crises is not just temperament, it is knowledge. He has studied enough history, enough businesses, and enough human behavior to know that panic always fades, and opportunities always return. This perspective is the fruit of decades of consistent learning. If you want to think like Buffett, commit to learning as a lifelong practice. Do not measure progress by weeks or months, but by decades. Build habits of reading, studying, and reflecting. Every day, seek to grow a little wiser. Over time, the difference will be extraordinary. Focus and consistency give you the structure. Lifelong learning gives you the fuel. Together, they form a foundation that few can shake. These traits have carried Buffett through wars, recessions, bubbles, and technological revolutions. They will carry you through the storms of trading as well, if you are willing to embrace them fully. Risk management is the invisible shield behind every great investor. Most people admire Buffett for his stock picks, his empire, his billions. But if you peel back the layers, you will see that his true genius lies in his obsession with protecting capital. He has often said, "Rule number 1, never lose money. Rule number 2, never forget rule number 1." Of course, losing money in the short term is sometimes inevitable. Even Buffett has positions that decline. But his principle goes deeper: never take risks that can destroy you permanently. Never place yourself in a situation where one mistake can wipe out years of progress. This philosophy is at the heart of risk management. Buffett avoids leverage. He despises unnecessary debt. While many hedge funds gamble with borrowed money to amplify returns, Buffett prefers the slow, steady growth of compounding. Why? Because leverage can kill. It magnifies not only gains but also losses, and when losses spiral out of control, survival is impossible. Buffett has lived long enough to watch brilliant investors collapse under the weight of leverage, and he has no interest in joining them. He also manages risk by staying within his circle of competence. He refuses to invest in what he does not understand. This is not stubbornness, it is risk control. Every time you step into a market you don't fully understand, you expose yourself to hidden dangers. Buffett avoids that by keeping his playing field narrow but deep. He may not invest in everything, but what he does invest in, he knows intimately. Another dimension of Buffett's risk management is liquidity. He always keeps cash reserves, ready to deploy in times of crisis. While others are fully invested and forced to sell at the worst possible moments, Buffett's cash gives him the flexibility to buy when prices collapse. This not only protects him but also positions him for opportunity. Risk management, in his world, is not just defense, it is offense. For traders, risk management is often the difference between survival and destruction. You may have the best system in the world, but without risk control, one bad day can end your career. Setting position sizes, using stop losses, managing leverage, these are not optional. They are the core of longevity. Buffett is living proof. His fortune is not the result of one big win but of decades of compounding, uninterrupted by catastrophic losses. Think of risk like oxygen. You don't notice it when it's there, but when it's gone, nothing else matters. Risk management is what keeps you breathing in the markets. Buffett breathes easy because he never gambles with survival. Closely tied to risk management is the eighth secret of Warren Buffett's psychology: long-term vision. If risk management protects the downside, long-term vision unlocks the upside. Together, they form the engine of compounding wealth. Buffett's long-term vision is legendary. While most investors obsess over quarterly results, Buffett thinks in decades. He does not care if a stock goes down next week or next month. He cares about where the business will be in 10, 20, or even 30 years. This perspective transforms how he invests. Short-term volatility becomes irrelevant. What matters is the durability of the business, the quality of its management, and its ability to generate cash flow for decades to come. Consider his investment in Coca-Cola. He bought shares in the late 1980s and has held them ever since. There were countless times when the stock dipped, when analysts predicted the decline of soda, when the world shifted to new trends. But Buffett's vision was long-term. He understood the global brand power of Coca-Cola, the emotional connection consumers had, and the durability of its distribution network. Decades later, it remains one of Berkshire's largest and most profitable holdings. This long-term vision requires psychological strength, because the world constantly demands short-term action. Shareholders want quarterly profits. The media wants headlines. Traders want instant gratification. Buffett ignores them all. He stays focused on the horizon, not the noise. Long-term vision also protects you from emotional mistakes. When you know your timeline is decades, a 10% drop in a month means nothing. It is simply part of the journey. But if your vision is only days or weeks, every fluctuation feels catastrophic. By expanding your horizon, you reduce stress, increase patience, and align yourself with the power of compounding. For traders, adopting a long-term vision does not necessarily mean holding positions for decades. It means aligning your mindset with longevity. It means building habits, strategies, and risk practices that you can sustain for years, not just days. It means focusing on becoming the kind of trader who can survive and thrive for a lifetime, instead of chasing fast money that burns out quickly. Buffett once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." That is long-term vision. The trades you take, the habits you build, the knowledge you acquire, they are seeds. Over time, they grow into trees that shelter you, feed you, and sustain you. But only if you are willing to wait. The combination of risk management and long-term vision is rare in today's world. Most people ignore risk until it destroys them. Most people abandon vision the moment they face setbacks. Buffett shows us that by protecting the downside and focusing on the horizon, you can turn decades into compounding wealth. These secrets are not glamorous. They will not make headlines. But they are the foundation of Buffett's empire. And if you adopt them in your own trading, they will be the foundation of your success as well. Humility and self-control may not sound like the traits of a billionaire investor, but they are essential parts of Warren Buffett's psychology. In a world where wealth often breeds arrogance, Buffett has remained remarkably humble. He still lives in the same modest Omaha house he bought in 1958. He does not flaunt luxury or chase status symbols. His humility is not an act, it is a strategy. Why is humility so powerful in trading and investing? Because markets punish arrogance. The moment you believe you are smarter than the market teaches you a brutal lesson. Buffett's humility keeps him grounded. He does not pretend to know everything. He admits his mistakes. He stays within his circle of competence. Humility protects him from the overconfidence that destroys so many traders. Self-control is the twin of humility. Without it, even the smartest investor will fail. Buffett's self-control is legendary. He does not get swept up in market manias. He does not panic in crashes. He waits, studies, and acts only when the time is right. His self-control allows him to resist temptation, ignore noise, and stay true to his principles, even when the crowd is screaming at him to do otherwise. There is a story often told about Buffett at shareholder meetings. While thousands of investors sit eagerly waiting for his words, Buffett calmly eats peanut brittle and drinks Coca-Cola, cracking jokes with Charlie Munger. This calmness is not casual, it is discipline. It is the outward sign of an inner self-control that keeps him steady in storms. For traders, humility means admitting that you will be wrong, often. It means accepting losses as part of the process, not as personal failures. Self-control means sticking to your plan, resisting revenge trades, and never letting emotions dictate your decisions. Together, humility and self-control form the shield that protects you from yourself. This brings us to the final psychological secret of Warren Buffett, the psychology of value. At its core, Buffett's entire philosophy rests on one idea: value matters more than price. Most people are obsessed with price. They chase rising stocks because they see numbers climbing. They panic when prices fall. They live in a world of surface-level signals. Buffett looks deeper. He asks, what is this truly worth? The psychology of value requires a mindset shift. You must train yourself to see beyond noise, beyond volatility, beyond hype. You must learn to distinguish between price, the number flashing on your screen, and value, the underlying worth of a business. This is not easy. It requires analysis, patience, discipline, and independence. But most of all, it requires psychology. Why? Because markets are driven by emotion. Prices swing wildly based on fear and greed, often far away from true value. The trader who follows emotion gets caught in these swings. The trader who focuses on value sees the truth beneath the noise. Buffett has built his fortune on this principle, buying when value is clear and holding until it is fully recognized by the world. Think of his investment in the Washington Post in the 1970s. The company was trading far below its intrinsic value due to temporary fears. Buffett recognized the opportunity, bought heavily, and watched as the stock multiplied over the years. Price had been depressed by fear, but value was untouched. That is the psychology of value. The challenge for traders is that value requires patience. It requires waiting for the market to align with reality, and that can take years. Most people are too impatient, too emotional, too addicted to action. Buffett thrives because he embraces the waiting game. He sees volatility as opportunity, not as danger. The psychology of value also extends beyond money. It is about recognizing what truly matters in life. Buffett values time, relationships, reputation, and integrity. He understands that real wealth is not just numbers in an account but the freedom to live as you choose, surrounded by people you trust. This mindset has guided his decisions, both in business and in life. As you reflect on these 10 secrets, patience, discipline, emotional detachment, independent thinking, focus and consistency, lifelong learning, risk management, long-term vision, humility and self-control, and the psychology of value, you will notice a pattern. None of them are technical tricks. None of them are shortcuts. They are psychological foundations. They are ways of thinking, ways of being. This is the real lesson of Warren Buffett. His success is not a magic formula. It is not luck. It is not timing. It is the result of a lifetime of mastering his own psychology. He built habits that protect him from fear, greed, arrogance, and impatience. He aligned his behavior with timeless principles, and he repeated them consistently for decades. If you want to trade like Buffett, do not start with his stock picks. Start with his psychology. Train your patience. Strengthen your discipline. Detach from money. Think independently. Stay focused. Keep learning. Manage risk. Hold a long-term vision. Stay humble. And always, always, seek value over price. In the end, the greatest investment you can make is not in stocks, bonds, or businesses, it is in your own mind. Master your psychology, and you master the game. That is the legacy of Warren Buffett.